Did you know you can borrow money from your life insurance policy without a credit check, without paying taxes, and at the same time, all of your cash value still continues to grow? I'm gonna show you exactly how in this video. So when it comes to life insurance, there are certain policies that allow you to build cash value. Now, the way it works is every policy has a cost of insurance, cost to, admin fees, whatever the cost is for the policy. And let's say the cost is $100. If you put $100 into that policy, you're paying for the cost. If you were to put $500 into the policy, you're paying for the cost, that first $100, and everything above that, in this example, the $400 goes into your cash value. And that cash value is what earns interest credits or compound interest and grows over time. Now, as it reaches a certain amount or a certain time frame, you're able to get a policy loan directly from the insurance company, equivalent or a little less than whatever they allow you to based on the amount of money is in your cash value. So for example, let's say I had $50,000 in cash value and I need to take out $40,000 for some other type of investment. I want to put a down payment or something, whatever I want to do with it. I have complete control. So I do whatever paperwork they need me to do. They send me $40,000, and the reason they're going to loan me the $40,000 is because I have that $50,000 sitting inside my cash value that's used as collateral. Now, when I request those funds, remember there is no credit check to get the money and is 100% tax-free to me. Now, because it is technically a loan, you will be charged an interest rate, but let me explain how that works. So there's typically two types of loans. Let's say it's a fixed loan. Fixed loan, I'm going to request the money from the insurance carrier. And let's say they charge me a 4% interest rate. So I'm going to get charged 4% every single year. Now, because that money came directly from the insurance company, it was never technically moved out of my cash value. Now, the amount equivalent to my loan is still earning compound interest equivalent to whatever the rate is. So let's say it is a 4 for 4. So they're charging me 4 on the $40,000, but I'm also earning 4 on the $40,000. So that's what they call a wash loan or a zero net loan, because everything I'm charged is being offset by everything I'm credited. Now, I also have the option of doing what's called an alternate loan or index loan. Now, these loans are specific to a product called Index Universal Life or IUL. Now, in this scenario, let's say I'm charged 5% on my loan. The great thing about the index loan or alternate loan is that my cash value can still follow whatever the stock market does with a floor and a cap. So let's say my money can grow with a cap of 10%, floor of 0, and the market were to do 9% that particular year, and I'm getting charged 5% that particular year, I actually make a 4% spread. So I'm being charged 5, but the market produced 9, so I earned 9. So I'm able to make that difference, and that extra difference is credited towards my cash value, which adds to my compound interest. Now, of course, that type of loan comes with more risk, because if the market were to perform less than 5, let's say the market performed at 3, I'm still paying that 5 and I only earn 3, so I'm at a negative 2% charge that particular year. So it's flexible. You can switch loans typically every anniversary of the loan, but it can be a way to create a spread or an arbitrage on your money if you're okay with taking on that extra risk. Now, some important things to understand before you take a loan is that when you take a loan from the insurance company, that's going against your cash value, which essentially will be collateralized as part of your death benefit. Now, if you don't pay back that loan because you are not required to pay it back, it will be paid back at your death, because that cash value that was used as collateral for that loan is part of your death benefit. It gets added to your death benefit. So that will be reduced from your death benefit if you were to pass away, or when you pass away, should I say, with that outstanding loan. So it doesn't have to be paid back in your lifetime, because it will be paid back as part of your death benefit when you die. Also, you want to keep an eye on your loans, because you don't want your loan balance to get too high to where it ultimately will lapse your policy. But trust me, before you reach that point, you will get a lot of notifications from the insurance carrier, and I'm sure your agent will reach out as well. Now, if you have a life insurance policy already, you can reach out to your agent or reach out directly to the insurance carrier to see if yours is the type that has cash value. So if you have questions, put them in the comment section, and I'll see you in the next video.